Hey everybody, thanks for tuning into this video. My name is David and welcome to my channel. Today we're going to be talking about market volatility and how to protect your investments during market volatility, especially if you're near retirement, so ages 55 to say 64. If you're not in that category of people, no worries. Watch the video anyway because it's good information. It's actually universal principles and strategies that you can use to protect yourself from market volatility. But if you're in this near retirement group, this is who I'm going to be paying attention to today with the language that I'm going to be using. So that's what I want you to focus in on. Let's look at the first thing, and that is focus on your goals, what you've achieved, and not so much the headlines. Headlines are like this: crisis. It's designed to make you nervous and scared and think about, oh, should I invest money? Maybe I shouldn't invest money right now. What's really important is that you focus on how well you're doing, look at what you've made so far, your achievements, and then focus in on what is the path going forward. Look at this chart here. This is a 2-year chart of market volatility showing 4 indices: the Dow Jones, the S&P 500, the NASDAQ, and the S&P TSX. That's our Toronto market. And look at the right-hand side just for a second. That 2-year period, the NASDAQ's plus 80, the S&P is plus 46, the TSX is about 30% up, and the Dow Jones is up 26. It was much higher, right? The markets have come down over the last 3 months, but that's your 2-year rate of return in those indices. And on the left-hand corner is the COVID sell-off. People were freaking out. You remember those days, what that was like, thinking we're going to run out of groceries and not be able to get what we needed, and we had to work from home, getting vaccinated, all this chaos in our lives. And I bet you weren't focused in on how did the market recover over that 2 years. It did, but we didn't really pay attention to that because we're so busy trying to figure out just how to live, how to have a normal routine when the government was changing our routine all the time with restrictions, can't go out, can go out. It was crazy, right? But the markets have recovered to at least the pre-pandemic level. But look at here is where we have been the last 20 years. Remarkable growth, 1,000% increase in the NASDAQ. So think about, you've done really well. If you've been investing in this time, you've made money in your house. Your house is much higher than you ever had possibly ever dreamed of. And you've got money in your portfolio as well. So don't get caught up in these headlines because it's distracting. It's just noise. Pay attention to your financial plan. Your financial plan actually illustrates everything you need to do in order to be successful between now and through retirement. Focus on that. If you don't have a plan, get with an advisor. They'll give you a plan. I do them all for my clients. They're free. They're included in what I do for my clients. Now, number 2, control what you can. When I say control what you can, what that really means is you don't control the markets, but you control the one thing, and that is when you deposit money. If you can control how much and when, I don't mean timing the market, but you are willing to buy or invest in those securities as they were running up over those 20 years, you just kept buying into that because you need to put money away. But the cost of those things was going up and up and up. Now that when market volatility comes, whether it's, after COVID or any of these, depending on when you're watching this video, when market volatility comes, that's an opportunity for you to invest in the thing that you actually, the security that you actually have had so much confidence in. It was a good company or a good fund, and you invested in that, and it's now gone lower slightly. Start investing. You might want to think about, now's the time to cash in some of those GICs that you've been saving because you weren't sure about what to do with that money. Now's the time you should invest. Review your risk tolerance. This is actually very simple. You should do this every single year. Sadly, a lot of people don't do that. People who are investing on their own, they don't often review the risk tolerance. They just simply, keep investing the same way they've always done. And so what happens is they get caught with being vulnerable in times of being too much equities given their age and timeline to retirement. So think about this retirement zone, the 5 years before retirement and the first 5 years of retirement. This is that 10-year retirement zone. You want to minimize the amount of severe negative returns you have in your portfolio. This is really important. So think about what you're investing in, how much equity versus fixed income. So if you look at that from a point of view of a risk tolerance scale, on the left-hand side, bottom left-hand corner is conservative, so that is 85% fixed income, 15% equity. That would be somebody very old, and someone who's very conservative, not really wanting to take on too much equity because they're afraid to lose money. And it may be they might have a lot of money, or maybe they don't have a lot of money and they're thinking, that's all the money I have from the world. I got to make sure it lasts my entire lifetime. Now, if you move up and to the right diagonally, you see that this is aggressive growth at the top. This is 80. So the values have reversed here. 85% equity, 15% fixed income. So as you get older and closer to retirement, you want to be moving down closer to that left-hand corner so you are maybe balanced down to moderate. If you need to be conservative, that's one thing, but I find most people in retirement tend to be in that moderate or to a in-between balanced, if you will. Very few people who are retired, in their 70s and 80s, want to have 60% of their money in equities, unless they've got a pension income, they have other sources of income. If this is all the money they've got, they generally don't want to be that risky of an investor. So this is what you want to review every year. And your financial plan actually talks about what kind of rate of return you're going to need. So if you've got an advisor and they do financial plans, pay attention to the rates of return, pay attention to what kind of inflation rates they're using. And you want to just focus in on the fact that if your financial plan says, like this one is as an example, this one says 5.65%, the required rate of return in order to produce $73,000 for the rest of their life, then you don't need to be going after 10 and 12%. You don't need to, push all your money to the line and go after such a high rate of return when all you need is 5.65. I'm all for having more money. I'm all for saying, great, we've got a higher rate of return. But bear in mind, you're putting your retirement at risk just so that you can have, ego of saying, I'm making 10 or 12%. Be smart with your money. Be savvy with your money. It's this game, if you will, it's a long-term game. You're going to be in retirement for 30 years or 40 years, depending on when you retire. And that's a long time for your money to last. So you don't want to have years where you have negative 30%, right? Okay, last one is work with a trusted advisor. This is obvious, but you want to be able to talk with an advisor. If market volatility has you worried, then you're not communicating with your advisor. Maybe your advisor is just not listening to you, or you don't hear from them. Often at times advisors, they're afraid to make phone calls, and they certainly don't want to deliver bad news, and they'll avoid making those calls. Great advisors don't do that. Great advisors talk to their clients in any market condition, especially in volatile markets, because the goal here is that you want to calm your client, right? You want to be calm. You want them to have faith in the plan that you've put forward, that everything is fine, that you're on track. That's what you want to hear from an advisor. And not just that, though. You may want to hear from an advisor, it's an opportunity for you. Those are the conversations you want to have with your advisor, not these ones here. And how I help people, and I say to them, just think about it as maybe your advisor, maybe you're just outgrown your advisor. You were introduced to them when you were a young person, and now you're 50 or 60 years of age. You're not the same client, and maybe they've not changed who they work with. They tend to work with a younger group or younger families. And they're also, when you first came to them, maybe you didn't have a lot of money, but now you do. Maybe your portfolio is $1 million, $4 or $5 million, and they're not really comfortable managing that kind of portfolio. And to call you in a negative time and your market, if your portfolio is down 5%, that's a lot of money for people who have millions of dollars in terms of being down. So they may not be comfortable having that conversation. So it's important you work with people, with advisors that work with your age group and dollar amounts than advisors who are not familiar with that kind of thing. So maybe you've just outgrown your advisor. What you need is somebody who's going to be able to put all the pieces together that are their daily job as an advisor is working with people just like you. That's what their main focus is. It's one of the questions I tell people to say when you're interviewing advisors. Who are your typical client? What age groups? What's the dollar amounts that you normally manage with them? Get a feel for what kind of client or what kind of advisor this is and what kind of clients they have. Well, I hope you enjoyed today's video. I enjoyed giving you this information. And I want to remind everybody that we take care of your wealth management so you can take care of what's most important to you. I hope, again, that you enjoyed this video. Thanks for taking the time to watch it. I look forward to seeing you in the next video. If you have any questions, put your comments and questions below, and I'll get back to you as fast as I can. I also love hearing your video suggestions, so if you have any suggestions about what kind of material you'd like for me to talk to you about, then go ahead and put those in the comments too, because I think it's important I deliver content that you want to hear about. Again, thanks very much. I look forward to seeing you in the next video. Take care. Bye-bye.